always assume it's going to take at least 50% longer for the business plan to be achieved, and be prepared for that. Always assume that operating expenses are going to grow faster than you want them to.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. I'm your host, Jeremy Dyer. Thank you again for joining us on another episode of the Freedom Point. Really appreciate you being with us today. I have another amazing guest with me today, Irwin Boris. Irwin, welcome to the show.
Thank you so much for having me, Jeremy. Thank you.
Yeah, absolutely. Really appreciate you being here with us today. Really excited to dive into some of your background and kind of journey and story and how you help investors. Before I do that, I wanted to give a little brief bio on Irwin. He's a member of the investment committee for Heritage Capital Group, which is a third-party generation real estate family office. He advises investors on existing and potential investments and provides asset management services. Irwin has more than 30 years of experience in real estate, finance, investment, asset management, and has participated as a direct lender, principal, investment banker, and advisor in more than $5 billion in real estate transactions. Irwin, there's not a whole lot of people that I have on my podcast that can tell me that they've been in the real estate industry for 30 plus years. Would you mind kind of helping us unpack a little bit more about kind of what that journey has looked like in the last 30 years leading up till today?
No, absolutely, absolutely. So I've worn a lot of hats, and that's why I have no hair anymore. That sort of killed all my hair follicles. But I started. I have an undergraduate degree in accounting, took the CPA exam, and at the time I went to work for a national firm. We had a lot of real estate clients, so we did a lot of audits, both for condos, co-ops, construction, management companies, and that's I sort of caught the real estate bug back then. So, and then when I got tired of accounting, I went to work for a very large owner-operator who was on the Forbes list, 30 years ago. So God knows where they are today on that list. But they were one of the largest residential landlords, and I actually got to see what goes into those numbers on how hard it was to manage residential property, and especially in the city of New York and the surrounding municipalities. How do you collect your rent? I had to go to landlord-tenant court. I had union buildings with union crew. I had to deal with federal and state agencies. And so I've worked either for owners or for banks, with credit training and making loans to these people. So, and as a lender, I'm one of the few people that have actually held a brick in their hand. So it was kind of interesting. I looked at things a little differently than someone who was a traditional finance credit trained person who had actually never been in the management side. So it became, a good segue from there to go to what people call the dark side on the ownership side. And because then you sort of know what the banker's thinking, know what it is to operate the building, and then know what you want as an owner. So you could sort of, predict what the lender's going to say, what could go wrong, and how to properly structure it for longevity.
That's great. So let's talk a little bit more maybe about kind of your own personal, investing journey, and then how you've been able to take your own personal investing journey and apply it to, the family office dynamics, or maybe it's the other way around.
Well, I was taught, through some of the clients in my accounting career and early on that if you couldn't underwrite the deal on this, it probably wasn't worth buying. And even through the years, people I've worked with said to me, "How could you make a calculation, on a 3x5 card on a scrap of paper? You don't need a computer to build a model." I said, "Well, if I'm building the model, that's really the gravy. But if the basics don't make sense on the back of an envelope, I'm not that sure if I even want to go any further. Um, and that's how I personally invest. I know that you always want a profit. And so, but if I'm happy with the cash flow and I assume I have to hold it forever, am I good with the investment? And even on the family office side, all right, if the treasury is paying 4.5 and you're getting 10, and assuming you hold it for 10 years and you sell it for your basis and you got the tax deductibility and you can exchange it to something else, are you happy with that downside analysis? And everybody will say, yes, that's not so terrible. It's when you lose money that people have a problem with. That's my number one rule: never lose money. And it's been a good motto, and it's helped me make a lot of good investments personally and help others with their investments as well.
Yeah. Now, for my listening audience, Irwin was holding up a napkin to illustrate if you can't underwrite a deal on a napkin, right? To kind of use that as an analogy. So, for my listening audience that may be a little bit less familiar with the underwriting process that either you have traditionally gone through in the past, your family office does, could you give my listening audience maybe the underwriting 101? What does the process typically entail? What do some of the inputs typically look like? How do we, how does the average investor maybe kind of stress test, themselves, some of the numbers on the underwriting model?
No, sure. Right now we're investing in industrial and multi-tenant, small bay industrial as well as big box industrial. And so for us today, we're underwriting on what is the cash flow. And if you know what your contractual rent is in place, and a lot of these buildings are either modified gross or triple net, so you know what your net operating income is. And you're looking at what your yield is unleveraged. So if I'm buying on a 9% return and I'm financing at 6 and you're borrowing 60%, you can pretty much figure out what your available cash flow is, either for improvements or to distribute to investors. Multifamily, I look at it the same way. What is the current occupancy, or really what is it should be? If it's not 93, 95%, why isn't it occupied? Sometimes, owners run out of money to keep units online or renovate them. And so I would take my rent roll there. I'd figure 90, take 7% for vacancy and collection. I would figure 45 to 50% expenses, depending on what environment it is. And I'd pick a cap rate. What kind of return do you think you should deserve before financing? You're looking for a 7? I'm not buying on a 5 when I know I have to finance on a 6. I don't want to be upside down. So I'm always looking for positive leverage. If you want a little more risk and you're investing in a value add where you're going to be upside down, buying on a lower cap rate, there you have to have a little more tolerance for risk, that things may take a little longer to turn around because there's always going to be a speed bump. More recently, in the last 2 years, we've seen insurance in some markets triple. So if you're paying $200 a unit insurance, you could be paying $600 or $700 in insurance. We know with the inflationary period, nobody underwrote payroll going up 4 or 5% a year. In addition to real estate taxes, as we came out of the COVID pandemic, all the municipalities wanted to recoup some of the money they laid out or didn't collect. So you have to have a margin for error, and a lot, and when you look back at who are today's sponsors, the younger generation, most of them in the last economic downturn were either in high school or in college. 2007 through 2011. And so they haven't seen a lot of the cycles of some of the more experienced people. And that's why if you look at, who's in default and you look at the age of the cast of characters, it's not surprising.
No, it makes sense. Let's talk about, since you've been, in real estate for the last 30 years, you've undergone a number of different, economic cycles. You went through the 2001, challenges. You went through, the global financial crisis in 07, 08, 09. Now, we could almost say 2021 has been some, challenging times with the historic rise in interest rates. What are some ways that you personally, or at least advised investors on helping to protect against that downside?
Sure. One thing we've always told people is term is your friend. So if you're financing, don't necessarily think you're going to make out better with short-term floating rate debt, because the worst thing that can happen is your debt is maturing and you have to focus on a capital markets event, and you really can't focus 100% on the operations of the property on moving it forward. And depending where rates spiked, like now, you have to put more equity in to that property to keep it, or replace your interest rate cap. And it's not a good situation. That's what a lot of people are facing now. So if you took the longer term debt, all right, there's a prepayment penalty. Just maybe hold it a little bit longer. It's like insurance. You never want to have to worry about it. So we were, 3 years ago when we all switched from LIBOR to SOFR, we did a bunch of floating rate loans because they were very attractive, and we knew we could swap them. And when you're borrowing at SOFR 150, how could you not take a 7-year interest rate cap? The bank didn't require it. And some of our partners said, well, what are you doing? You don't need 7. The bank's only requiring 3. I'm like, well, look how cheap the cap is. Wouldn't you rather spend a little more money and sleep better at night? And we had the discussion, and they said, you know what, you're right, because if rates move up, the cap is valuable. And now our caps are tremendously valuable, and we sleep at night. And on some of these deals now, I think the current return is 14 or 15%. So
Wow.
Always take longer term debt. Never assume that the timing is going to work in your favor. Always assume it's going to take at least 50% longer for the business plan to be achieved, and be prepared for that. Always assume that operating expenses are going to grow faster than you want them to. And don't try to outsmart yourself or outsmart your investors if you're a syndicator and saying, well, rent's going to grow at 7% and operating expenses are only going to grow at 2 or 3. Because that didn't work out too well either.
Yeah, right. Let's talk a little bit more about these rate caps. So I know that there's some sponsors in the space that do the floaters, right? Bridge loans primarily, and they purchase this rate cap, right? How expensive are these rate caps typically, and are they more expensive during times of uncertainty, at least as it pertains to where the Federal Reserve Bank is intending, to move, that SOFR rate to?
Sure. Today, if you were buying a cap today, on a new loan, and you wanted protection from rates rising, I can't imagine that it's very expensive, because everybody's now predicting that rates are going to fall. But back when we bought our caps, no one ever thought rates were going up. So they're looking at the yield curve. So right now the yield curve is on a downward slope. So the cap is cheap. But when the rate cap is on an upward slope, depending how fast people are predicting it's going to increase, and the longer the term you want, is really going to be a function of who wants to take that counterparty risk. So today, buying a cap is not going to be as expensive because no one's predicting it's going up. But if you have to replace an old cap that's expiring, like we looked at a distressed deal that's on the market in Atlanta. The sponsor is into the property for almost $180,000 a unit. He's trying to avoid a foreclosure on his record, so he's willing to sell it for $110,000 a door. He's going to take a big bath. And I'm looking at it, and I finally get the loan docs, and I'm like, oh, it's a floating rate debt. That's not good. They tell me what the interest rate is, but then when you start to dig in, and I reached out and I said, well, how much is it to replace the interest rate cap? Oh, it's about $1.2 million. I'm like, not for me. Because then I have to bring additional money to finish the renovations of the building. And I just don't see getting out where I'm really making any money. And I'm not buying anybody else's headache.
Yeah, absolutely. That makes sense. Let's talk a little bit about the internal rate of return. Again, I want to speak specifically to that investor that may not understand fully what the internal rate of return is as it relates to its comparable, and that being the annual rate of return. Would you help maybe unpack a little bit more for our listening audience in terms of what exactly the IRR is and how it's different from the AAR?
The internal rate of return is sort of a time value of money. How long you hold the investment, what is the profit, what were the distributions over time, and then you get there's a full formula, and you'll get a return. But what investors need to realize that don't invest based on a projected internal rate of return, because I can tell you with 100% certainty, whatever that number that's projected, it's not happening. Sometimes you're lucky and it'll exceed that. But in a lot of cases, especially now, people are finding out it's going to be less. In some cases, a lot less. So I think a better decision process for an investor is to look at what the annual return is, or cash yield, that you can expect to receive. Don't focus on the preferred return that's in marketing, because that's a theoretical number. That's a number that's used to calculate what the sponsors promote, or their override out of the profit would be. That's all it is. Just because it says 9% preferred, don't ever expect to receive 9% on an annual basis. So what you really need to do is to see how well capitalized the building is. Is there rainy day money for unforeseen things? And then let's look at what the interest rate is and what are you getting in cash flow now. And this, because I'm always assuming that there's no upside in a deal. So as I said at the beginning, if I'm happy with the cash flow for 5, 7, or 10 years, I'm getting all my money back, great. If I make a profit, even better. So that's how I look at an investment. And I think that, when the early years in multifamily, coming out of 2010, 2011, it was really hard to screw up an apartment building deal. All the leaky boats came off the bottom of the ocean. And syndicators kept doing these deals, and their LPs kept making more and more money. I think the last couple of years, the LPs got really lazy and probably did a lot less due diligence. Didn't look at the model. Oh, I did 3 deals with this guy, I'm going to make money. Or I did 3 other apartment deals. This is great. And I think that a lot of them got lazy towards the end.
Yeah, I would agree with that. I think there was a lot of people that were running into the fire when maybe they should have been running out of the fire.
That's a good expression. I think so. They figured, lightning's not going to strike, and I'm still going to make money. And, and then there are sponsors that, for some reason, never really gave you full access to all the due diligence. Like, I was solicited by a very big social media personality, and it was an interesting story because they're telling me, oh, we have this portfolio of 3 buildings in Houston. We're buying from Alliance Residential. And I'm like, all right, they built the buildings. I do my independent research. And the business plan was, we're going to take them from 88% to 92% and raise rents 15% over 3 years. Both of these things are going to happen. And then they're showing a big refi cash out. And that's where all the IRR is all of a sudden is generated. And I'm thinking, well, if Alliance Residential, the dinosaur, the big operating company, couldn't do it, how are you going to do it? Oh, we have ways of getting it done. And then when I asked for a model, they sent me a PDF. At that point, I didn't have anything else to say to the guy, because you're not going to give me a working model. He goes, what do you need to see my assumptions for? I said, I want to stress it.
Right.
So, so even today, if they're not giving you access to everything, including a working model, run the other direction.
Yeah, absolutely. That full transparency is incredibly important. And I would wholeheartedly agree, with you. I personally only invest with lead sponsors that are willing to give me access to the entire data room, right? In addition to the fact that I only invest with sponsors that will give me access to the same level of detail that they provide the senior lender every month over the course of that investment hold period. So really appreciate, you calling out, that full transparency. I would like to ask you a question just out of curiosity, and that is, as it relates to the IRR versus the yield on cost, which of those particular metrics do you tend to favor more than the other?
I look at yield on cost. I'm looking at the yield on cost just on the purchase price. I'm looking at yield on total capitalization. I prefer that because I have to, I'm assuming there's no upside. And if I'm comfortable with those numbers, and I know my cash flow on, unleveraged or even on a leverage basis is going to yield me 10% a year, I can't think that I'm ever going to see less than a 15 or a 16 IRR on the backside, just from cash flow. And rent's moving 3% a year. And then if there's really appreciation, and maybe a little cap rate compression, which I think we could. Today, depending what you're buying, I could understand that, and I've debated that with some of my institutional partners, and everyone will now agree that in 5 years, it's very likely you'll see at least 150 basis points in rate cuts. So there is some warranted cap rate compression, but historically, everybody always assumed cap rates were going to expand. And, except for the last couple of years, where syndicators got really creative. Oh, we're going to go in at a 4, we're going to sell at a 4. Like, yeah, that's very nice. So I would be focused more on the cash on cash because models are very easily manipulated.
Yeah. What would you say are some of the really due diligence items that a limited partner, passive investor that really doesn't understand, the inner workings of how underwriting works? They don't really understand, kind of all the details in terms of, what the sponsor actually does to execute, that business plan, right? What would be some of that due diligence that that investor, really should be doing before they decide to send that wire transfer in?
Well, the first thing is know your sponsor. And the first thing I always do is someone sends me something, I just want to see what they own. So I'll put their name into the search bar in Google. And now what I would do is I'd even put their name in and say defaulted loans, loans in trouble, and things like that, and see what comes up in the search bar. And then, as you talk to these people, I would ask them, hey, tell me about some of your troubled loans. And when they don't fully disclose, then that's a red flag. But I would do that. That's why I like to have the answer before I ask the people what's going on. Because I even saw like Greystar Real Estate Partners had a deal that I think was foreclosed or in the teetering towards foreclosure. And if Greystar, who has probably 700,000 apartments in more than one country, has a problem, there's a general problem in the apartment industry. So that's one of the things: is really do your due diligence on the sponsor. Look at the CapEx budget. Look at the model. What are they growing expenses at? If they're growing the expenses at 1 or 2% a year, and you have that model, change that to 3 or 4 or 5% a year. See what tolerance the model can absorb before things go upside down. If they're telling you they're taking floating rate debt, I'd be asking the questions about interest rate caps. Although today I don't think it's important because everyone will probably tell you rates are going down, and I would agree with that. Although I did hear somebody on Bloomberg say that maybe rates might go up one more time. But if anything, if the worst case is going to happen, is going to be no rate cuts in 2024. I
Yeah.
don't see it going up anymore. So I would say floating rate debt is probably safe today. But I would also look at how many deals the sponsor actually has that are not full cycle, and how are those progressing in today's market. Uh, ask the questions: how are your budgets going on your renovations? Because the costs of renovations, like we have one legacy asset down in Virginia Beach, and we started, I think, a one-bedroom apartment was about $10,000. Now it's up closer to 20 to renovate with granite and new cabinets and appliances and the flooring. So you want to find out, how they're doing and see what information they're going to give you. And the other thing is you should have access to everything that they have on the property, zoning, title, insurance, operating history, appraisals, engineering, environmental reports. They should be willing to give you everything, and you should have access to that on a lifetime basis as it's updating. So you want to, not that you would read it all, but you want to know if they're willing to give it to you. And
Yeah.
then you also have to figure out as an investor, what is my tolerance for risk? Can I afford to lose any of my principal? And if your answer is no, which it really should be, that you don't want to lose any of your money, then look for something that's triple net. I'm not saying buy a Walgreens or a CVS or something like that, but look at something that you're comfortable with the contractual cash yield, and you're not focused on an IRR because you think you're going to get rich. When you think about it, you can't eat the IRR. So if you're investing for cash flow, at least if you have several cash flow investments and they're all making 8, 9, 10, 11%, cash flow buys luxuries. The appreciation of the value really creates the wealth. So if you're really thinking of IRR is going to create my wealth and I'm only going for grand slam home runs, you're going to be disappointed and get some strikeouts.
Yeah, that's true. That's so true. And you're exactly right on the risk tolerance side. Every investor has a different, risk tolerance profile, right? And, usually that correlates with maybe how old they are, or maybe it correlates with, what investments they're currently in terms of whether or not it's maybe time to dial down, on some of those, riskier type investment opportunities that they're in. So I really appreciate you highlighting that. Um, when it comes to commercial real estate investments as a whole, there's a number of different, asset classes within commercial real estate. What are a couple that you particularly like right now?
No, we like anything where the landlord or the property owner doesn't have to absorb the increases. because you can't predict those. I can't predict what insurance is going to do, or if there's going to be a special assessment, or taxes are going up, or my payroll is going to triple, things like that. So, as I said earlier, we're doing mostly large industrial and small multi-tenant, small bay industrial buildings, because they're, if not all of them, are triple nets. A few are still modified gross, where the tenant is pro rata on any of the increase in the operating costs. And that's why we like those assets. We still do look at multifamily, but we haven't found any recently that makes sense in today's operating environment, because I'm not buying at a cap rate that's lower than my cost of finance. That's my cushion for reality. If I'm not going in negative where there's negative cash flow after debt service, because it's a value add. So I think people really need to look at that. Retail has taken a beating for a while. You have malls going out, anchors downsizing. Neighborhood strip centers, grocery anchored is probably good, because the grocery store brings in everybody there. There's some fast food, if you're buying on a coupon and you want to buy a Wendy's or something like that. And just, if you have to park the money somewhere, let's say it's a 1031 exchange for taxes, maybe you do that. Office is kind of interesting. In some markets, office is doing well. Like, someone asked us if we wanted to invest in a Class A tower in Tampa. It's a great deal. I just don't have the tolerance right now for office. Miami, they're still building office. New York City, they're trying to figure out what to do with it. Although everybody is mandating back to work because they have a current lease, my thoughts are that as these leases start to expire, and to keep people and your workforce, you're going to be more tolerant of a hybrid. And that if you had 300,000 feet, maybe you only need 250. And so there might be some downsizing. I think in a lot of markets, some of the older office should be converted to multifamily to the extent that makes sense. Down in the Wall Street area in New York City, many buildings got converted years ago. I don't know if the purchase price of some of these buildings warrants conversion, and we'll have to see what happens with those. I know some of the older hotels are getting converted to motels, getting converted to apartments, because they already have the plumbing and the electrical infrastructure. A lot of those will make sense. If you're investing in a hotel, it's real estate, but it's more of an operating business. You have to figure out who your flag is, who your management company is, how are they keeping it full? Can somebody build a new hotel down the road and steal all the guests? But hotels do make money in resort areas, as long as there's no pandemic, so to speak. What else did I miss? I think I got covered it all. So it also depends on risk tolerance. Retail is probably a little more risky, because it might have more downtime if one tenant goes out before a new one comes in. Office is definitely a lot more risky now. But if you have staying power, generational money, and you can buy the building. Like, if you look at who some of the wealthy investors are, they're buying buildings. They're buying for the next 100 years. And so some of the New York City buildings are trading like that. But yet in San Francisco, you have major owners like Brookfield walking away, tossing the keys to the lenders, because they don't know if they'll ever get them full again. So I would stay away from office unless you really have some serious money I can afford to lose.
Yeah, that makes sense. I did want to get your perspective on something and educate, our audience with this concept of, positive versus negative leverage. You talked about that kind of relationship between interest rates and going in or going out, cap rates. So I wanted to get your perspective on, what do you think at this time would be kind of that healthy, arbitrage between interest rates and cap rates in terms of maybe that, positive leverage?
Sure. We're looking at a few deals now. One actually is being marketed by Blackstone, and the pricing guidance is like a 5.5, and everyone's telling me, oh, you'll stabilize 3-4 years from now closer to an 8. I'm like, great. I said to the broker, leave your commission in escrow until that happens. That doesn't go over too well.
No.
But I know that this asset that they're trying to sell on a 5.5 is I'm gonna probably finance it, especially where treasuries are today, at least on a 6.5. And so that's not working for me. So I'm offering to buy the building on a 7.5, because I know the value add is there. So on a value add, I still want to buy at 100 basis points above the going in place cash flow. In some places, because the markets have gotten beaten up and sellers just want to sell. They've owned forever. You can find buildings at 9 and 10 caps. I'm negotiating a contract now for a building. It's their only asset left in this Atlanta market. They've sold them off piecemeal, one by one, from a larger portfolio. And finally, I got a call that said, make me an offer. So I made them an offer on a 10 cap. They sent me a contract. So, first of all, if you're buying for yourself, don't be afraid to ask. If you don't ask, you don't get. So I've asked for sellers to hold paper. I've asked for sellers to finance 60%. I've asked for sellers to stay in for a piece of equity if I don't know if I could raise it all. If I want, it also tells you what their confidence is in the deal. If they want to stay in for the equity, then they believe that there's some upside in the deal. If they're willing to stay in and be a lender, even in a second position, it tells you they have faith in the building. So, but in general, I'm not going in at a 6 if I'm financing at a 6. I got to go in minimum on a real good value at least 100 basis points wider. That's me personally, because I'm risk adverse. But others might go in at flat. But also, what investors need to figure out, if you're buying on a 5 and financing at a 6 or a 6.25, you have to work so much harder just to get positive cash flow. And you really need to have the risk tolerance and enough money in the capitalization for something that's going to go sideways.
Yeah, that makes sense. I appreciate you kind of outlining that for the audience. So my next kind of question for you would really be, what's next? Do you have a particular bucket list item for 2024, maybe either personally or professionally?
Well, this year we're actually seeing a lot of inquiries from high net worth investors, and we've worked with some in the past, but I think that a lot of people got burned in apartment deals and are still going to get burned, and that's another thing we can talk about, how some of those sponsors are now out raising preferred equity funds to save their own deals at the expense of their other LPs. But I like individual investors that want the cash flow. So we talk to a lot of doctors, a lot of trusts and estates. People just want the cash flow. They want the shelter. They want the additional losses for other passive income that they have. So we're actually building out our platform to accommodate a lot of smaller investors, which we have not done in the past. We're seeing a tremendous amount of deal flow on 8.5, 9, 10 caps on multi-tenant industrial assets, infill locations, barriers to entry, which we haven't seen in a while. And I think I probably have the next 24 to 30 months to have really fun, assuming the capital's there, before rate cuts really cause a cap rate contraction. And at that point, we'll either refinance and make the investors happy, or potentially just roll them up and sell. So I think it is a good opportunity if you have dry powder, even on the multifamily side. But I think, as people are saying, it's what do they say, stay alive to 25 on the multifamily side because of the wall of maturities. So if you're an apartment investor, I'd probably sit on the side till sometime, in mid 25, maybe early 25, after some of these foreclosures have gotten cleared the market and some of the distress has created real opportunities.
Is there a particular book or podcast that you particularly like to read or listen to that might the listening audience might find some value in?
Well, I've listened to a lot of podcasts and I've read a lot of books. The one thing I thought was interesting is Robert Cialdini, who's a psychologist. He's got this book on influence. And when I look, someone told me to read it, and I don't, and so we talk about the psychology of sales. And the one thing I've noticed as of late from social media that I've seen is you used to see a lot of syndicators out there trying to get investors. Now I see a lot of capital raising boot camp, and I think what they should need is underwriting boot camp is really what they should offer. What's a good investment? What should I run from is really the training people should offer. And that's why I'm happy that you're having me here today so we can talk about this. But I think that you should listen to everything and read a lot of books and listen to a lot of podcasts. Everyone is going to have a different point of view, and nobody is right or wrong. I'm never going to tell you I'm the smartest person in the room. I'm going to tell you I've been very lucky based on everything that I've experienced and everything that I read and I learn. And that's why it's like people, and I tell people, our investments are boring. They say, what do you mean they're boring? I said, they just pay cash flow. There's no fame, there's no fortune, there's nothing you want to put on the cover of your corporate brochure. I'm not Blackstone, I'm not Starwood. I just want good bread and butter investments that pay continual dividends.
Yep, absolutely. Amen to that. Well, it's amazing what happens in investing when education, intuition, and luck combine, right?
No, it's absolutely what it is. It is the recipe for success. So anybody that's that arrogant and tells you that they know what they're doing, I'll listen, but I go, he's the adversary has an ego problem or he's selling too hard.
Yeah.
And like even when I've spoken at a family office conference and they said, well, how do you raise money? I said, never ask for it. I said, all you can do is try to educate people, show you how you add value and align your interests with them. It's like we put real equity, that's meaningful equity to me personally, and my partners into the first loss position. When you look at syndicators, most of them don't have a nickel in a fund. It's 100% OPM, other people's money. And that's a problem. There's no alignment of risk there. Yeah. And that's why I got to think twice about that. And some of them will never have any money. And they have no money in any of their deals. So how are they going to protect them? Yeah, they're going to protect them because they're also the property manager and they want that stream of income in their other pocket. So that's another thing that you should ask is, who's the property manager? What's the alignment of interest between you and the property owner and the vendors that are doing work on the property?
Yeah, so that's actually one of the litmus tests that I ask a sponsor, and that is if the lead sponsor is not willing to put in a minimum of 7 figures of their own money into the deal, then I'm out, right? I need to have full faith and confidence that they're not surviving, based on that asset management fee or that acquisition fee. So that's a great point. What would be maybe 1 or 2 different ways that our listening audience can connect with you to learn more about what you're up to, Irwin?
No, that's sure. They could, I'm highly searchable on the internet. You put Irwin Boris, IRWIN Boris into the search bar on Google, you'll find me. You can go to heritagecapitalgroup.net. I'm on Facebook. I'm on Instagram. I'm doing a lot of podcasts now. Someone told me I should start my own, although I don't know how you do it. But, I think there's plenty of ways, to contact me and see what we're doing. We look for, as I said, cash flow investments. And obviously we have lots of references and as well as a war room of old deals. You want to look at how the accounting worked out, it's fine. I believe in full transparency. Like I've sent investors monthly financial statements and I said, what was this? It's like 8 megabytes. I said, what do you normally get? They said, sometimes we're lucky. We get a 1-pager on a quarter. We send out a full set of financial statements. You have a balance sheet, an income statement, copy of the bank statement, accounts payables, receivables. If you were an institutional investor and you wanted the general ledger, God bless you. Look at it.
Well, Irwin, again, yeah. And Irwin, I really, again, appreciate you being on the show with us today. Thank you very much for your, value that you've been able to provide the listening audience.
No, my pleasure. This was fun. I'm happy to do it again. Well, we can have an update. I'm sure there'll be some news as, later in the year as some of these foreclosures start to happen and some of them clear the market.
And listening audience, thank you again for joining us on another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.